What are gilt funds and why should you be looking at gilt funds now, especially now? Gilt funds or government securities funds are funds that invest in securities issued by the Government of India. Now, Government of India is one of the largest borrowers in India. They borrow a substantially large amount of money and they are in the market all the time to borrow. Therefore, mutual fund schemes that invest in these government securities are referred to as G-Secs or gilt. Gilt meaning almost gold equivalent. They're safest kind of. That's the analogy. The advantages of investing in gilt funds is that there is no risk. Government cannot go bankrupt because they can always print additional currency. They have the printing press, Therefore, your principal amount and the interest is extremely safe at any given point in time. Having said that, government securities are subject to a lot of volatility. They are very susceptible to interest rates. So they constantly keep changing values depending on how the interest rate movement is. So to that extent, one needs to be cognizant that while the principal amount and the interest is very safe in G-Secs, they also can be very volatile in the short term. What is the timeline that one should look at investing in G-Secs? Typically, government borrows for long term. They borrow for periods of 10 years, 20 years, or 30 years, as the case may be. Therefore, your investment in G-Sec funds should also be slightly longer term. If not for 10 years, at least you should look at it from a 3 to 5 year perspective. Why 3 to 5 year? Because 3 to 5 year allows you to run through an entire interest rate cycle. Therefore, you are not exposed to any great risk. That's why you need to look at it. Too short a time is not advisable in G-Secs because interest rate volatility may impact your investment returns. What is the underlying security that G-Secs invest into? Most G-Sec funds as a mandate have to invest at least 80% of their money in government securities funds. Therefore, there is an intrinsic safety about the way your funds are meant to be handled. 20% they may manage in treasury bonds and other bonds, which are also government related, but which are more liquid in nature. This is how G-Sec funds operate. One of the important aspects for us to understand is by investing in a G-Sec mutual fund, how is it different from directly investing in government securities? Now, when you invest in a government securities, today RBI allows an individual to invest in government securities as well as a retail investor. Now, when you invest in that government securities, you essentially enjoy steady interest rate per se. Because most investors invest from point to point. So if you're investing for a 10-year period, you invest today and you take that interest on a month-on-month basis, and at the end of 10 years, you get your principal amount back. But in a G-Sec fund per se, when you invest, you're not investing in one government securities, you're investing in a basket of government securities. So your overall return will be two components. One is the weighted average of the coupon, the interest rate that each of those bonds derive will come back to you. So one is you get a regular return that comes to you on a periodic basis, maybe an annual interest and so on and so forth. The next income that the fund earns is in the form of appreciation or a depreciation of the underlying security. Now, what is this concept of appreciation or depreciation? Mutual funds have to recognize their underlying security on the basis of what we call a mark to market. In simple terms, the security has to be valued every single day, and depending on the external environment has to be valued at the right price. It's easy in the share market because the share price of the underlying security changes very evidently every day. So is the case with government securities. The rates keep changing on a daily basis and one needs to include that. Now, why does this rate change and how does this rate change? To simply explain, whenever interest rates are moving up, the value of your government securities will depreciate. Therefore, you will incur a capital loss. And whenever interest rate is trending down, security value of your government security will go up. Thereby, you will incur a capital appreciation on your holdings. To explain it in a more layman terms, I'll give you with a small example. Let us say you bought a government securities worth 1000 rupees at a 7% coupon rate. What this means is that 1000 rupee investment will yield you 70 rupees every year for 10 years, and at the end of 10 years this 1000 rupees will come back to you. Now let's say after you bought this bond, government decided to increase interest rates by 1%. Therefore, from that day forward, the same government securities for that same period, people would get an 8% return. Therefore, when you go out into the marketplace to sell your instrument, you already have only a 7% coupon. The only way somebody will get an 8% return by buying your bond is if they buy it instead of 1000 rupees at say 970 rupees or 960 rupees. Because 70 or 960 with a kind of cash flow will give them an 8% return. So this is a very simplistic way of looking at it, but enough to drive the message that as interest rates moves up, your bond value will depreciate, and as interest rates moves down, your bond value will appreciate. And this is an important component of why one needs to invest in these gilt funds, because apart from the coupon, you will also enjoy a capital appreciation. Of course, there's also a risk of capital depreciation. Why gilt investments now? We have seen that globally over the last 2 years, inflation has been at a record high. US has been seeing 40-year high inflations. India is no different. We have also seen very, very high inflation. To tackle inflation, governments across the world have raised interest rates very, very high. So clearly this level of interest rate is unsustainable. But governments are determined with the fight to bring inflation down. And we are finally seeing some signs that the inflation is starting to come down. Therefore, over the past few months, we have seen that most governments have done what we call the long pause. Continue to maintain interest rate at these levels, not increasing it, not decreasing it. So this has been the feature. But eventually our view is that interest rates will come down. Maybe a year and a half, or even lesser. Interest rates are bound to come down. And when interest rates comes down, having invested in G-Secs, you will not only enjoy coupon, but you will also enjoy capital appreciation that will come with it. Having said that, you must be as an investor prepared for short-term volatility. Within the next year, if interest rates don't move down or they stay where they are, or if there is a mild inflation because of which interest rates tends upwards, you may even see a capital erosion on your investment. So come in if you have 3 to 5 year timeline and you're willing to kind of ride it. Our belief is that a low double-digit return is definitely possible looking at how the economics work. So if you have 3 to 5 year timeline, a low double digit could be a good return that one gets out of gilt. But it is not guaranteed and it is subject to market risks, as they say. Now, who should invest in these funds? First up, high net worth individuals who have a certain amount of money that they need to deploy in debt should definitely look at gilt as one more area that can give them a good return going forward. Yes, it is volatile, but if you have a 3 to 5 year, this is a good place to generate a certain amount of return. If you are 50 years and above and you want to earn a higher return but want it to be safe as well in some form, today gilt may not be a bad idea to look at. It's a good investment, and as interest rates trends down, you will make an alpha on your investment. Third, if you're somebody who has been in equity markets in the last 2-3 years, has seen substantial profits on your equity portfolio thanks to the equity market doing so well, this could be a good time to take some profits off the equity funds and park it into gilt. Gilt is another good way of ensuring that you're protecting your profits. For all these reasons, I believe it's an interesting time to look at gilt funds. But I'd also like to leave you with this message. As the mutual funds ad say, past performance is not an indicator of future returns. The gilt fund last 2 year returns is quite pathetic. So don't look at the past 2 years of gilt fund returns to validate your desire to invest into Gilt. Those who do that will miss this bus. You just have to believe that eventually the interest rates will come down. You want to take a bet and therefore you want to commit to these investments. If that's your idea, then there is money to be made on the table.